I love the colorful clothes she wears and the way the sunlight plays upon her hair.
So I was asked by a friend, his name's George, to evaluate an article, Why Overfunding Life Insurance Makes Retirement Sense. And as I said, about 80% of what this fellow is saying about an index universal life insurance policy is true. Where I disagree is in the comparisons, because you cannot really compare a pre-tax retirement account where you get a tax deduction to a post-tax investment in, say, a life insurance policy and not take into account the tax savings, which, based on my cursory review of this article, this fellow didn't do. Now, Tim, it is very competitive on a net after-tax basis. So I wouldn't be embarrassed to show a side-by-side comparison, but I would never recommend that someone do, say, a life insurance policy as a retirement vehicle instead of a 401k plan or whatever. Now, are you agreeing with me or you disagree with that?
I'm agreeing with you. There are some times where, what you want to do is max out your 401ks, or at least max out what matches will be before you decide to do anything else with your other monies. But if you need life insurance, if you have a long time horizon, if you're in your, let's say, mid or low 40s and you have a long time horizon, an index universal life does have a lot of opportunity to get some pretty good gains and create that tax-free bucket of income money that you can use in retirement.
And that's the key. That's where the thing really starts to shine, because remember, the money coming out of the 401k, you got to pay taxes on it, et cetera, et cetera. And I think you're going to find that in most instances, there will be competitiveness, but the 401k may outperform a little bit. The index universal life may outperform a little bit, depending on one's tax bracket and the fees they're paying inside the 401k, et cetera, et cetera. But it is not a replacement of a 401k or a Roth IRA. And unfortunately, a lot of people in your industry, and you have to admit to this, a lot of people in your industry sell it the wrong way. They sell it. They say, you're an idiot. I hear the ads all the time. If you've got money in that 401k plan, you're going to lose all your money. And if you invest with me, the market goes up, you make money. Market goes down, you don't lose money. In fact, the bald-headed dude that runs these ads all the time, I looked at the graph that he showed the other day, and it is a very misleading graph because it shows the index annuity is what he's pitching. Right. And it shows that outpacing long-term the performance of a stock portfolio, which is not going to be true because you've got caps and participation rates and all that stuff. So if these guys would just be honest and use it for what it's good for, that is a supplemental retirement plan for individuals in high tax brackets who need life insurance, who have a strong cash flow, et cetera, et cetera. It's a fantastic plan.
Yeah, 100% agree. That it's unconscionable, some of the ads and things that you do see out there. But yeah, and it's not index universal life, great retirement option, but for the right situation, and it shouldn't be a replacement for any kind of a tax deferred plan to start with. So definitely, you got to look at that. But you
did bring up something interesting. If you fund your 401k up to the max, and you have a hankering for wanting an earlier retirement, let's say you're 40 years old, and you say, you know what, I wouldn't mind hanging it up at 52, 53, and I'd like to get some income out. The life insurance policy does give you the ability to take income out long before 59 and a half.
Right. And there's no maximum. So I mean, if you have the money, and you have the ability, it's a great source because you're not limited to the ERISA types of plans that are out there that you're limited with how much you can put in. Here is an unlimited amount of money that you can put in and create a tax deferred or tax-free account for retirement income.
Now I was talking to one of my other buddies, Brian, who actually sells these things for a living, and he brought up something to me that I thought was quite interesting. And that is, with many of these types of policies, you also get an acceleration of the death benefit. Like in this article, this $25,000 contribution to the supplemental retirement plan created a $1.1 million death benefit. And if somebody gets sick or gets Alzheimer's or whatever, you can tap into that death benefit tax-free early for long-term care, correct?
100% correct. There's usually chronic or terminal illness riders that are included in all the new policies that are sold today.
And they don't charge extra for that?
They don't charge extra for that.
So you're saying I was 100% correct?
Correct.
I love that.
Almost. Well,
That's why my guests keep coming back. Thank you for that. All right, so let's move on to some other topics here. Why overfunding life insurance makes retirement sense. George asked me to review this, and like I said, George, it's 80% accurate. It's 20% off base. If you happen to be an individual that's already maxed out in your 401k, you either make too much money, can't qualify for Roths, or you're already maxed out on Roths, and you have surplus long-term money, and you expect to be in a high tax bracket, pre and post-retirement, then an index universal life, and a lot of people like whole life better. I don't, but you might, call someone like Tim, and he can do the side-by-side comparison. I just think it's a matter of flexibility. Aren't they all pretty much priced the same?
They're all flexible, but make sure that one thing, especially if you're a high earner, you have that protection in place to protect that income stream for the people who are dependent upon it. That's really the basis of a life insurance. And once that's in place, then you can start doing these other life insurance programs as well.
Okay, let's move on. Let's move on. Let's not talk about death. Let's talk about life now. Life expectancy. The planning decisions that you have to make based on, or at least affected by your life expectancy, are as follows. Number one, when do you take Social Security? It's a biggie. Obviously, the longer you wait, the more you get, up to 70 and a half. It could be 75% more income. Then you've got claiming strategies with spouses and so forth. Life expectancy has a lot to do with that. In fact, I've got an email question on that very subject today. Number two, what pension option to take? This is another interesting one, because do you take the pop-up option? Do you take the joint and survivor benefit? Do you take the life only? All of those deal with life expectancy, and in this case, joint life expectancy. I mean, you may croak in 3 years, but if your wife, in this case, lives 33 years post-retirement, the option that you select, the pension option that you select, could be worth a lot more money. Whether to buy an immediate annuity. I went out on a limb the other day, and I said, based on the research that I got from Michael Robinson in the article that he wrote, How to Live Forever, holy mackerel. People are living a lot longer, and they're saying they may uncover an immortality gene in our lifetime. And I said, you know what? When Wade Pfau, when Michael Fink, when the guys from Think Advisor and the research from all around the country says pretty much dump your bonds, your stupid bonds, and your bond funds and buy annuities. You don't have to buy a lifetime income annuity. You can buy an index annuity or some kind of an annuity that has the guaranteed withdrawal benefit. And during the accumulation phase, it's a bond alternative. And during the decumulation phase, it's a guaranteed lifetime income payment.
Yeah, we're working with advisors all over the country and educating them on the best features and how to position those index annuities as alternatives to bond portfolio. Just a portion. You don't need to replace it all, but just a portion. And you can create a lot of extra income. You got the same kinds of yields. Matter of fact, one of our products is, I won't talk about the exact product, but it's beat the S&P 500 by about 78% in the last 15 years. And it's had less volatility than the S&P by 68%. So it's less volatility with adequate yield. You're going to do really well.
Is that an indexed product, or is that a variable product?
An index product.
So there's no downside risk in it?
Correct.
Wow. You have to show me that one.
It's very
You're
solid.
Sure about that? It's beat the index, not the index with dividends.
Beat the index with dividends.
With dividends. Mm-hmm. I'm challenging. I'm betting you lunch on that one.
Sounds good.
How much inflation protection is another decision that has to be made. And here is where a good advisor can really help you. Because as I've said like 1,000,001 times, inflation Post-retirement is different than inflation pre-retirement. I need to rephrase that. Spending, inflation's the same. It's going to affect you and affect you more. But your spending patterns are significantly different post-retirement. And then number 5 here, whether to keep your life insurance. There are a lot of people that dump their life insurance policies, and they shouldn't. Because by the time they're 65, 70, and they don't want them anymore, their internal rate of return on that policy is better than buying bonds, better than buying stocks, better than buying anything after tax, right?
Very, very true. It's one of the, and it's the best way to transfer wealth to the next generation.
Tax-free transfer of wealth. It could be not subject to estate taxes if you play your cards right. Listen, this is really important information. If you want more, go to safemoneymonitor.com and say, I want to talk to Tim Morton. We'll be back with email.